Welcome to Mandatory Money Matters. Imagine this. You're setting sail on the ocean of personal finance, navigating through the waves of expenses and savings. But there's an undercurrent that often goes unnoticed: the hidden costs of debt. Today, we're embarking on a journey to explore how interest rates subtly, yet significantly, impact your financial health. Let's dive into this crucial topic and uncover the truths beneath the surface. As we start our voyage, the first thing we encounter is the concept of interest rates. These are not just numbers. They're like the winds that can either propel your financial ship forward or drag it down. Interest rates, set by entities like the Federal Reserve, influence how much it costs to borrow money. When they rise, so does the cost of your debts, from credit cards to mortgages. For instance, higher mortgage rates mean higher monthly payments, affecting your budget and financial plans. Have you fallen into any debt traps? Comment below and don't forget to subscribe. Let's break it down with a mortgage example. Say you have a mortgage of $250,000 at a 4.5% interest rate. Your monthly payment is around $1,267, leading to a total interest payment of $254,017 over 30 years. But if this rate drops to 3.5%, your monthly payment reduces to $1,123, and the total interest plummets to $154,140, which is a saving of over $50,000. The story doesn't end here. This scenario is a reminder of how closely our personal finances are tied to the broader economic environment. Interest rates not only dictate our monthly payments, but also influence our decisions, whether to buy a house, refinance a loan, or even how much to spend on credit cards. As our journey progresses, we come across the real burden of debt, the total cost of borrowing. It's easy to focus on the amount you borrow, but the interest adds a significant layer to this. For example, if you're paying off a $10,000 credit card debt at an 18% interest rate, by only making minimum payments, you might end up paying nearly double the original amount over time. This part of the voyage teaches us an important lesson. The longer your debt journey, the more interest you accumulate. It's like sailing against the wind. The longer you take, the harder it gets. Minimum payments on credit cards are a perfect example. They might seem convenient, but they extend your debt journey, leading to more interest accumulation. Our financial expedition takes a crucial turn as we look at how debt impacts our broader financial goals. Imagine you're saving for retirement but are also managing a sizable debt. The money that could have been growing in your retirement fund is instead going towards interest payments. This diversion of funds can significantly affect your future financial stability. High-interest debts, like those from credit cards, can delay your ability to invest in stocks or other assets. This delay can mean missing out on potential returns, affecting your long-term wealth accumulation. Moreover, the weight of debt can drag down your credit score, especially if high-interest payments lead to missed payments or high credit utilization. Steering our ship further into the realm of debt, we encounter an often overlooked storm: the psychological and health impact of financial stress. Carrying the burden of debt isn't just about numbers and interest rates. It's also about the mental and emotional toll it takes on us. The constant worry over debt can lead to anxiety, stress, and in severe cases, depression. Think of it as sailing through a relentless storm. The strain of navigating through high waves of debt can affect not only your mental well-being, but also your physical health. Stress is known to potentially increase healthcare costs, adding another layer to the financial strain. Furthermore, the turbulence of financial stress can seep into your work life, impacting your productivity and professional performance. It's a cycle where financial strain impacts health, and poor health, in turn, can lead to increased financial strain. As we seek calmer waters, it's crucial to find ways to navigate efficiently. One key strategy is managing and reducing the interest burden. Techniques like the debt snowball or avalanche method can be effective. These approaches involve focusing on paying off either the smallest debts first or the ones with the highest interest rates, respectively. This strategic repayment can help lower the total interest paid over time. Another tactic is refinancing or consolidating your debts. For instance, consolidating high-interest debts into a lower-rate loan can significantly reduce your monthly payments and the total interest paid. Similarly, negotiating with lenders for lower rates or structured payment plans can make managing your debts more manageable. It's like adjusting your sails to catch the wind more effectively. By using these strategies, you can make your journey through debt quicker and less burdensome. Our journey nears its end as we look towards the horizon, planning for a debt-resistant future. This starts with creating strong defenses like a well-planned budget and an emergency savings fund. These practices reduce your reliance on credit and help you weather financial storms. Education plays a crucial role here. Understanding interest rates, financial products, and their implications equip you with the knowledge to make smarter borrowing decisions. Being cautious about taking on new debts and understanding the terms and conditions of any loan you consider is crucial in maintaining a stable financial course. Finally, responsible borrowing is key. It involves not just avoiding unnecessary debt, but also understanding your capacity to repay and the long-term implications of any debt you undertake. This concludes where we navigated through the psychological impact of debt and explored strategies to manage and reduce its burden. We also began charting a course toward a future that is more resistant to the dangers of debt. Now to the next part of our journey. Consider commenting on how you beat debt, subscribe, and like for more debt empowerment. Having explored the psychological impacts and strategies to combat the high seas of debt, let's turn our attention to the broader implications of these financial challenges. Our financial journey is not isolated. It's intertwined with the larger economic climate. Interest rates set by the Federal Reserve have far-reaching effects beyond our personal debts. They influence everything from the stock market to housing prices. When the Fed raises rates, it's often a move to temper inflation and cool down an overheating economy. Conversely, lowering rates aims to stimulate spending and economic growth. For instance, a rise in interest rates can make borrowing more expensive for businesses, affecting their expansion plans and investments. This, in turn, impacts employment and wage growth. On the personal front, it could mean higher loan and mortgage rates, affecting your ability to purchase a home or start a business. Our financial odyssey also has a global dimension. Interest rates in the United States can influence global markets. For example, higher U.S. rates can attract foreign investors looking for better returns, impacting currencies and trade. This global interconnectedness means that changes in U.S. monetary policy can ripple across oceans, affecting economies worldwide. As we sail through these complex waters, we encounter various financial institutions, banks, credit unions, and online lenders. Each plays a role in how interest rates are applied and managed. They interpret the Fed's rates and decide how to apply them to consumer products like loans and savings accounts. Understanding the role of these institutions helps in making informed decisions about where to borrow and save money. Just as a skilled sailor prepares for changing weather conditions, a wise financial navigator anticipates interest rate changes. This means staying informed about economic trends and the Federal Reserve's policy decisions. It involves understanding how these changes can impact your loans, savings, and investments, and adjusting your financial plans accordingly. For instance, if you're anticipating a rise in interest rates, it might be a good time to lock in a fixed-rate mortgage or refinance existing variable-rate loans. Conversely, in a low-rate environment, it could be an opportune time to invest or take on a reasonable amount of debt for growth purposes. This segment highlights the broader economic implications of interest rates and the importance of staying informed and prepared for changes. It's a crucial part of understanding how to navigate the financial seas effectively. In this final leg of our journey, we underscore the importance of financial literacy. Knowledge is your compass in the world of finance. Understanding concepts like interest rates, debt management, and financial planning empowers you to make informed decisions. It's not just about knowing the terms, but grasping how they apply to your life. Websites, online courses, and financial advisors can provide valuable insights and guidance. Remember, financial literacy isn't a destination, it's an ongoing journey. The economic landscape is ever-changing, and staying informed is key to navigating it successfully. Savings and investments are the lifeboats that keep you afloat in rough financial waters. Regular savings help build a buffer for unexpected expenses, reducing the need to rely on high-interest debt. Investing, meanwhile, can grow your wealth and outpace inflation, securing your financial future. It's about striking a balance between the security of savings and the growth potential of investments. At the helm of your financial ship, personal responsibility is paramount. It involves setting realistic budgets, living within your means, and understanding the implications of your financial decisions. Avoid the temptation of easy credit and prioritize paying off high-interest debts. Remember, small, disciplined actions can lead to significant long-term benefits. As we dock back at the harbor, let's recap our journey. We've navigated through understanding interest rates, the real cost of debt, its psychological impact, and strategies to mitigate interest costs. We've seen how interest rates affect not just our personal finances, but the global economy. And we've underscored the importance of financial literacy and personal responsibility. Now it's your turn to take the helm. Use these insights to steer your financial future towards calmer and more prosperous waters. And if you found value in our journey today, don't forget to like, subscribe, and comment on Mandatory Money Matters. Join us in our next adventure as we continue to explore the vast ocean of personal finance. And with that, our journey concludes, weaving together the crucial aspects of understanding and managing the hidden costs of debt influenced by interest rates. This trip through personal finance not only informs, but empowers viewers to take control of their financial future.